Hey guys, get ready. This is going to be one of your most exciting trading sessions with me, Greg Secker, your host in the Trading Den. Today, we're going to learn the Bollinger Bounce. Now, the Bollinger Bounce is a strategy which tells us that markets are overextended to the north or overextended to the south. The safe money is made trading it back to the midpoint. This is called the Bollinger Bounce. I'm going to teach it to you right here, right now. Okay, with all of these trading sessions here in the Den, we start off with the Learn session first to really teach you the strategy so you can understand it. Now today, I'm going to teach you the short version of the Bollinger Bounce. This is where a currency gets outside of its envelope, so you're about to see what that means in a second, and then we trade it short, meaning we sell the currency for an almost, and I say almost, guaranteed profit. So let's start off right now going to the Learn section of SmartCharts. Now, of course, in the Learn section, this is where all of the trading is housed. We're going to jump straight into the Bollinger Bounce. I'm going to show you the short side of this strategy. Now, obviously, when you have the full subscription to SmartCharts, you'll see both the long and the short version. I'm just going to focus myself on the short version first. So let's get right into that right now. On the 4-hour chart, we would like to see the 50 EMA below the 100 EMA. Another piece of further discretionary analysis you could do is to check that both moving averages are angling lower and separating away from each other. We then need a bar to trade above the lower Bollinger Band. This could be the sign of an overextension to the upside and a possible sell the high scenario. The entry price would be 1 pip below the low of the previous bar with a stop loss 1 pip above the high of the previous bar, and a target level of a 1-to-1 reward to risk. Your order will be placed as a no expiry order. This means this will stay as a pending trade until you cancel it manually, or the trade is triggered by reaching your entry price. If a new bar goes on to form on the chart and the trade has still not yet triggered as it did not reach the entry price, then we simply cancel the order as the momentum we were forecasting hasn't presented itself. In both long and short scenarios, when you place the order inside the strategy, the entry, stop loss and take profit levels are placed automatically and to the default strategy settings. If the trade triggers but then hits the stop loss, you will exit the trade for a loss. If the trade triggers and then hits the take profit, you will exit the trade for a profit. After your trade has triggered, you can manually exit the trade by choosing to close it yourself at any time, regardless of whether it's in a profit or loss. Advanced traders may also use extra discretionary or technical tools to support the decision of getting into a trade, staying out of a trade, or targeting a higher reward to risk. So that Bollinger Band strategy is when the market is on the outer limits, right? It's either too far extended to the north, too far extended to the south. The safe money is always made trading it back to its average. If you can get that in your mind and stop trying to buy things that have already run too far or trying to sell things that are already too far south, you're going to be in safe territory. You're going to start banking profit. The reason people buy things that have already run too far is they don't know what they don't know. Therefore, they don't do what should be done. In other words, they're waiting for the market to convince them to buy something after having already moved a bit upwards, so they feel that they're in a confident trade. Problem with that is, of course, it's already moved too far north, and then you're going to miss the bulk of the move. Similarly, when things have fallen too far, people think, oh, this is really like crashing down now. Now's the time to sell it. It's already shaken out. The short sellers are going to be gone. And the next thing that's going to be happening is the buying. So most traders, I always say, are a chapter behind what's about to happen. And you want to be with the chapter, not a chapter behind. So if we're looking for emotional signals, if we're looking for anything other than reality of what's happening, you're always going to be on the wrong side of the coin. So what's beautiful about the Bollinger Bounce is you aren't going to get lots of false signals. You're going to get most of the signals. And I say most, the vast majority of these signals are going to be strong signals if and only if you trade that Bollinger Bounce when it's on the outside of the envelope. And that means when SmartCharts finds it, it will throw some signals up which aren't on the outside of the envelopes. Ignore those. The ones that you want are the ones where the price action is either on the short side or on the long side. In other words, where it's on the outer limits of that envelope. If it's there and there's a blue arrow, that's when you place the trade. So we're now going to do what we always do, is we're going to get right back into SmartCharts, leave the learn section, hop along from the learn to the charting section. We're going to get down and dirty and place that trade. So let's go into charts, jumping across now. Of course, we've got that vanilla screen. Here we can see there's just an Aussie CAD screen. You'll see it says no strategy to the right. I'm going to click on that and I'm going to find myself the Bollinger Bounce, which is, now look, this is interesting. I said there isn't many signals, and look at that. There is literally one. So you aren't going to get hundreds of signals. What you're going to love about this is when you do get a signal, you've got a pretty sure bet that you're going to make money. I mean, it is that good. There is obviously the odd signal which doesn't make money, and I'll show you which ones they are, and I'll show you the ones which do work. So let's have a look at the Aussie. So these are commodity currencies. Australian dollar against the New Zealand dollar, very leveraged to the commodities market. So when commodities move up and down, it does affect their currencies because they are highly leveraged. They're big exporters of commodities, clearly. So those commodity currencies are important to look out for. They correlate well with each other, and you're going to see some interesting patterns from that. Let's have a look. Aussie against the Kiwi. So here we go. Perfect. This is picture perfect. It honestly really doesn't get any better than this. Let me show you what I mean by this. You can see, and I've got my screen set up so that the envelope, that Bollinger envelope, is surrounding the price. And you'll see with this signal here, when the price was on the outer envelope, you will notice that the trade triggered beautifully and ran to a profit. Here was the profit target, here was the entry, here was the stop. Wonderful. Now look at the next one along. The price itself wasn't, if you notice, the entry was in the mid-range. So if you think about entering a position like this in the mid-range, let me just open it up a little bit for you so you can see it nice and clear. Use my grab tool. One of the things I love about SmartCharts is this grab tool. I can stretch the chart around and then bang it in the middle of the screen so it's nice and clear, not just for presenting purposes, but as a trader, we really want to be able to really focus in on what we're looking at so we're really clear. So this first one here on the left-hand side, on the outer envelope, as you can see, nice short. We went short here on the blue line. We'd have closed the profit here on the green line for a nice profit. Now, the second one along, notice the price was triggering not when the Bollinger Band was on the outer envelope. That is not a good signal. So even though SmartCharts threw it up, that's not one we would place because it's not on the outer envelope. Remember, the best trade here is on the outer envelope. The one that's triggering right now is literally picture perfect, and here's why. It's a high test. So I want to focus on this bar here to start with. The bar formation itself is a high test. Look, the left-handed handle is where that price bar opens. It opened, it rallied all the way up, and then for some reason, it's come shooting down. And that's why that closing price is much more towards the lower extremities of the bar than it was when it was up here. So in other words, it went up, touched the blue period moving average, dropped down, and now you're seeing a high test. A high test is a short signal. So what you've got on this particular example is a very strong price bar short signal, and it's at the top of the Bollinger Band envelope, meaning there is literally 3 cross correlators here which demonstrate this is a great short setup. Setup number 1, of course, is the Bollinger Bounce. It is at the outer extremities, just like this one was back here on the outer extremities. That worked beautifully. This one wasn't at the outer extremities of the envelope, hence why that one never got to its profit target. But this one, and this is the one we're looking at right now, okay, we've got the stop loss here, but notice how the price has gone out. It's a high test, which is a short signal from a price point of view. The price is at the outer envelope, which means this is the perfect positioning and the profit target is here. If you're unclear of whether you should be buying or selling, it should be pretty obvious by virtue of the fact we're at the top of the envelope. We're selling it to come back to that midpoint range. We have the signal with the blue arrow, which should give you the good indication it's a sell. If you're still not clear, just look at the buy and the sell buttons here to the right. The red button here tells you it's a short, and this itself is a picture perfect trade. So we have our entry here at 1043. We've got our stop at 1045. We've got our take profit at 1041. So here you go. You've got yourself a 17 pip stop. You've got a 17 pip profit target. That is a 1-to-1 reward to risk. We're looking to make maybe £2,500, 2,241. There's nothing to do on this trade but hit the green button. I can't make this any better myself. The entry position is perfect. The stop loss position is perfect. It's off a beautiful high test. It's on the outer extremities of the envelope. These currencies do revert to their mean. The only thing that could make this a better trade, if I'm being pedantic, is if the envelope was wider. If the envelope was greater, like it was before, it would have a stronger snapback. But my confidence level with this, given it's a high test, given it's the outer extremities of the envelope, to hit this profit target is very strong. We also know that the Aussie Kiwi market is massively in favour of clearly the Kiwi dollar at the moment. So we know that this is, from an economics point of view, it's from a fundamentals point of view, this is a strong position. This trade just needs to get on. So we just do that straight away by hitting the green button. That's bottom right here, the green button. You can see that on my screen. We place that trade and hit confirm, and that position is now on. Now the screen will now glow red, as you can see, which indicates that we will go short as soon as this line here crosses this line here. Now, if I decided that I wanted to be a little bit more aggressive on this trade and actually capture more profit. So whilst there is 2,000 some odd pounds of profit in this trade, if I wanted to increase the amount of profit on this trade, I could do that in one of two different ways. I could, of course, increase the risk. But given I know that this strategy is likely to now fall short, we've already seen the sell-off in that bar. That's why you've got the high test. I can actually edit this trade. So watch this. I can click the sell button. Now I'm in edit mode of a trade that's already the trade hasn't triggered, but the order is live in the market. If I now move my sell entry more aggressive to just below the low of that high test bar, what that now does, if I now OK that, it means that I will enter this position as it now breaks through just where this red line is here. It means my profit target, which I can now move to where the existing profit was, which is down here, I've now moved that from 2,200 to 3,200. And that is perfectly acceptable. Now I OK that. It means that I'm aggressively entering. If the next bar opens and enters me into that sell entry, it's the same trade. I've not had to increase my risk. I've kept my risk the same, but I've increased my profit by £1,000 purely because I'm trading off the bottom of that high test. When it then breaks down, it means I'm in a really elegant entry. I'm at the top of that channel, the top of that envelope, that Bollinger Bounce envelope, and I'm looking to add another £1,000, which means my reward to risk has now moved nicely in my favor. It's more of a 2-to-1 than it was a 1-to-1. So I'm in really great shape. I then hit the green button to confirm that edit change, and you can now see my entry is here, my profit target is here, and my my risk limit is very small. Now, if you like this, please hit like. If you haven't subscribed to this channel already, make sure you do that, and I look forward to seeing you in future videos.